Good evening, ladies and gentlemen. This is Clueless Trading Frank. It is approximately 8:23 p.m. Eastern Standard Time on August 9th, 2017. Full disclosure, this free market update webinar is being recorded and will be uploaded to the Clueless YouTube channel for free viewing. Full disclosure, this is purely for financial education and not for any solicitation or advice. So let's kick off, and I want to point out a bunch of stuff that I have been posting all through the day. And I was noticing that today was one of those days where I had probably a very large number of real-time online guidance charts starting off at 8:37 a.m. this morning. Started out a little bit late, and I believe they were close to 30. And if you look at the sequence of specifically the market charts, which are delivered via the SPX E-minis, primarily the ES and the SPYs, but primarily the E-minis, because those are the real guidance navigation system for the market, you will see a running, basically it's like an online visual tutorial of how things develop when situations like today, which has happened many times, a bottoming process occurs. And I think it's very important, after I give the pointers that how some of you should be looking at this thing, well, all of you should be looking at it, it'll make a heck of a lot more sense. So let's kick off with this particular one, which is, let me cover a couple of broad topics. Want to point out very clearly that since I constructed this particular chart back on around the 20th of the month or so, 20th of last month. So you're talking roughly 3 weeks. And this has pretty much the market's played out like that. It doesn't mean it's easy. But the volatility structure and the ranges of where the markets are going to trade in were clearly forecasted and alerted to all members well before all the shenanigans and the drama and the volatility that is a daily routine in the markets, and will be a daily routine in the markets going forward, and has been for a couple of years now, more so in the past 2 years. So this was already there. So regardless of whether we have a precipitous fall like we had the flash crash yesterday from the flash rally yesterday, all this was predicated. And I'm going to go through each particular inflection point. So for some of you, who are not really adept at looking at these type of volatility charts, it'll be pretty clear. So that's really my goal in getting this thing done today. So this, the flash crashes that, a couple of broader points here. Sorry, I keep on detracting here. Get used to these intraday 4 hour type of sudden volatility flash crashes, specifically from breakout levels. Just get used to it. It's just going to be the nature of the beast. They might not be as large as this particular one, which was a very large one. That's because the market shot up quite large and broke away from the range and hit a very specific trend line that I had drawn. And if you notice, it overshot that slightly by maybe 2 points or a point, and then reversed immediately. And so it might not be that large, but we have seen many of these. The bull market is not dead, period. Okay? It is not dead for many fundamental reasons. It's not dead for technical reasons. It's just not dead yet. Bulls don't die suddenly. Just remember that. I've been in the market long enough, and I'm just sharing my thoughts and my experiences with you. Bulls don't die suddenly. It's a process. And that process can be seen only through technical charts, which show some major indicators which start to falter. It can be the moving averages. It can be a negative divergence on the internals over a period of time, and you cannot detect, and it's a fallacy that you can detect the death of a bull market or the beginning of a bear market, which bears keep on talking about all the time, by looking at short-term charts. They can only be viewed on daily and weekly charts. The 1 hour resets that we get, the sudden 80-point drops, and the 50-point drops, which all of a sudden feel like the whole world's falling apart. Those are just pure resets and intraday type of corrections. Corrections have become faster and faster. And this correction alone, if you look at it, was a good solid. We dropped from roughly 2490 down to a low of 2460, give or take. So basically, we lost on a percentage basis. Just giving you exact percentage, we basically lost 1.2% within 4 hours. So Jeff Gundlach, for example, one of the most brilliant fixed income guys. I don't think he's a great stock guy at all. He's not a stock guy. Jeff Gundlach, who is a very authoritative figure. And if you notice, markets are very rigged and manipulative. They brought him along yesterday. Right smack middle on CNBC gave him a lot of exposure because he's talking about how he's buying long dated calls on the VIX. And he expects the VIX maybe spike to 20. I expect the VIX to spike to 20. It doesn't take much for the VIX to spike to 20. We get a 500-point drop in the market, the VIX will spike to 20. So, and he's saying, okay, maybe we can get possibly a 3% correction. Oh, whoopee. What's a 3% correction? A real correction in the market is generally between 6 to 8% going over 10%. You don't get 10% corrections in the market that often. In fact, you get maybe once or twice a year. Once a year is good enough. A 10% correction is a real bloodbath on the long side, and that is not something that's common, period. Okay, so he's talking about a 3% correction. We already got a 1.2% correction, and what I'm doing here is putting things in perspective, okay? Between yesterday's reversal with the North Korea nuclear thing, and then Trump coming out, the fire and fury comment, sending shivers across the world that, oh God, we're going to go out there and bomb North Korea right now. No, it's just not going to happen. Okay. And the bottom line is, all that tough talk. And bottom line, the markets, said, okay, we broke. Now we got to go down. There were enough profits to be taken, which we did too on this breakout. And stops get triggered, panic sets in, all kinds of good stuff. Retail traders basically, just run into the bunkers, all kinds of standard procedure. It is standard procedure. Human behavior never changes. Market patterns don't change. It's always the same. It's always the same. You all know that too. What feelings are when things fall, suddenly fall, and markets, crater 180 points or so from the top. That's really what it was on the Dow Jones Industrial Average. So it's the same routine. It's a playbook. It's the same routine. So saying all that, these type of corrections are becoming a norm, and they're good. They're good washouts. The 1.2%. Jeffrey Gundlach is saying 3%. So we already got almost half of that. Really, it's nothing to be surprised at. But they brought him along, and it constantly replayed the same thing about how he's expecting a pullback, blah, blah, blah. Then comes the North Korean issue, then the Trump's comments, and then North Korea saying they might overnight that they might bomb Guam, or which is a little island out there in the Pacific, and which we have a huge naval base and Air Force base and stuff. I don't know if you guys know. So anyway, so they started talking about how it might be like Pearl Harbor, and you name it, all kinds of good stuff. So our bottom line is that, so that's number one, get used to these flash crashes. And number two, we have had quite a few of these. All right, so let me just point them out, and I've showed them a couple of times. I'll show it again. And this is only going back to this is only going back to the 19th of last month. So you're not talking like years and years. We're talking like when we broke up into a new range, and that range happens to be, which I've consistently shown, is approximately around 2460, 2462, on the lowest end around 2458, and remember, we're talking about futures here. So you have to add roughly 4 or 5 points to that number to arrive at the SPX number. So 2458 is roughly around 2462 or so on the S&P 500. So just keep that as a mental note, and you have to always, when I'm showing you the futures, you just have to add that to arrive at the SPX figure. Anyway, so we're talking about just a few weeks. So here's one. Let me just change the color of this. Okay, there's one. Then you get minor retracements, not flash crashes, minor retracements. There's a big one. Okay, and that was only on the 27th. That was literally 2 Thursdays ago. 2 Thursdays ago, yeah. And then there's these little ones here. There you go, another one. And all these happen within a matter of an hour or two. Okay, that's the nature of the beast of algorithmic high-frequency trading programs. That's it. Fast and furious. Don't make these things up, okay? This is the real deal. So fast and furious. Immediate sells, stops get triggered, panic sets in, all kinds of stuff. Nothing fundamentally changes. It's just one of those things. Then you have this, and then you get these little ones, along the way, which are just minor resets. Then you get this big one from yesterday afternoon, right? So you get that culminated here. She got one. I'm looking at the primary flash crashes. 1, 2, 3, and this is the fourth one. So we're literally getting one intraday flash crash every single week. All right. Now let's keep this real simple, all right? Like the keep it simple, stupid method, right? So what happens after each one of them? As long as we know structurally, which I'm clearly showing, can't be any more clearer than this. I have shaded the box so you can see the range, and that range has not been broken. So it falls to the bottom of the range. And what has happened every single time that this has happened? This time's no different either. Believe me when I tell you. This time it's no different. Every single time the market has rallied. Move sideways, big, fat, short squeeze, hits my line. I say sell, which I did. SPX calls go berserk, 200 plus percent plus. Now we are here. Is this going to be, and I'm looking at the higher probability move, right? That's what we do in trading or investing. We're looking at the higher probability move. So if you just wanted to use the little crayon here, this is what's going to happen. Is it going to bust a move up here? I don't know. But this is going to happen. So when you look at these very simple, and let me clear this out. So you look at the range here. Okay, the range is 2480 or so. Low end of the range is around 2460. That's 20 points, roughly 120 Dow points, right? 20 S&P points times 6 roughly is 120 Dow points. So the market basically has been trading, and this is called volatility trading, which I specialize in. The market's been basically trading, and this obviously was a outlier, this move. The market's been trading in a 120-point band, not the end of the world. However, it affects different stocks differently, because what I've been noticing, and this is a very important point about the markets, and this is where flexibility comes in, that stocks are acting like stocks. What do I mean by that? What I mean by that is individual stocks, let's say earnings. We have played a whole bunch of earnings. Most of them have been winners. Some of them crap down. Okay. So Priceline, I lost a little chunk of money. I had one call. One call. Each call were $4,400. Okay. So I said, let's play it. Why not? Let's do it. Had a lot of profits from the other side. So that one call went to $300, by the way. Didn't matter. Made up the whole bunch and more on the reversal trades today. And there were a bunch of them. You know that. Nvidia was great. Tesla was right off the bat, 10-point reversal, 35 minutes. That's the power of machines and hedge funds day trading. You just got to be one quick little foot behind them and bang. And I detected it, showed it. Next thing you know, it just goes from down 5 to up 2 and then just rushes forward. And then ends the day down buck or two. Who cares? Take the fast move. So bottom line is, and it's still going higher, so it doesn't really matter. So based on the charts. So bottom line is that the stocks are acting like stocks. The market is rewarding stocks with stronger numbers, good guidance, no surprises, that type of stuff. If it's a very highly priced stock, if they're not meeting that full guidance, or they are, they think they're going to increase their spending, the next couple of quarters are going to be a little bit soft, they're punishing it. So it's become a market of stocks. And on the greatest days in the market, not every stock goes higher. We see that. Not every sector goes higher. Biotechs could be down. Techs could be rallying hard. Thursday, when we had this move higher, most of the move was not in all over on the biotechs. It was primarily in techs. They were just running the techs like nobody's business. That's the point that I want to make with all of you guys. So just so you understand, hedge funds trade the market like a beast. They have massive firepower in the form of leveraged capital. They can borrow 10, 20 times over their base capital leverage, right? And margin, and that's huge firepower. And they have the machines to do it. Not all of them, but all the good ones do. So they're going to just pick and choose, and they're going to run with one of them. Look at today. The big movers were specific stocks, and I was showing a bunch of them. The others are going to move too. So this notion that a lot of retail traders and a lot of you have, that just because the market's having reversal, everything's going to move higher with that, it doesn't work like that. And my service, I have always been a believer of speaking the truth. And the truth is not always very comforting. But that's okay. Because this way you guys deal with reality, not with some sort of la land theory that, market's going to reverse, go higher, everything's going to go higher. No, it doesn't work like that. Okay? So it's becoming a market of stocks. I work very, very hard in the background to show the stocks which are very much in favor that particular day. I show the swing stocks which are coming off the bottom. And that's my job. So I'm doing my job perfectly. You guys have to kind of figure out how you're going to manage your jobs to a degree where it can benefit you the most, because it's certainly benefiting me. And it's not easy. Of course, it's not easy, but that's all right. This is a big boy's job or big girl's job. Okay, this is not for kids. So that's the way I look at it. So get that notion out of your head that just because the market's turning around and you're sitting on a losing position, that all of a sudden that's going to rally with the market. No, that's going to turn around and run with it as long as you have the mental and the financial capability of holding on to it. Otherwise, you got to shift funds. That's what traders do. You shift funds. I do. And it works because all you got to catch is one or two very fast movers, and you're up for the day and you're up for the week. Just the way it goes. How are you going to learn how to do that? I don't know. I'm just going to keep on, mentioning the stuff, and then you guys just got to figure out how you're going to do it. Okay. I don't think I'm in a position to teach. There's nothing to teach. That really has to come from within you. How you're going to reallocate, move from one position, shift some couple of dollars into another, press the gas hard as that is moving forward, take the profits from that. That is trading. And in these type of markets, you got to do it. Second, overall, almost 70% plus of the earnings in the market have been on the upside. That's a good thing. Okay, and so that's there's no earnings recession coming. We don't have any particular real fundamental flaw in the credit markets where there's no rate tantrum. Rates are stuck in this 2.2%. The 10-year bond is stuck between 2.2 and 2.3, 2.4%. Great. When rates start to spike up big time, that's when a real correction happens. Just so you all know. That's when markets really fall out of bed. The fear that rates are going to go nuts and the Fed is going to hit the gas brakes hard. In other words, raise rates. Nothing like that is going on. But certain aspects of the market are overvalued, certain stocks are, and they're correcting on their own. So let's get into this before I deviate too much. So those are just some basic points I want to make. And then I put out some fantastic articles, which I think are going to be not just informative, very educational. It will help you with your trading on my Twitter feed. So feel free to read them. Feel free to read them. So here we are with this zone, this range here. So this range is very defined. We're back within the range. And this is what's going on. Retail traders tend to be, and a lot of our members too, even after a while of me sort of trying to change the mindset of how you look at the markets, I feel that many of you are still kind of stuck in this emotional gambit of thinking that markets have to break out and break down and all kinds of stuff. No, markets trade in a range. So if you're an index trader, you got to trade the range. So looking at these here, these big hammer reversals, this was a large one. There were multiple tails here, reversals, holding this support. You see congestion on my charts in this zone. I can't make it easier. I have little arrows. I have red arrows on the ones which have been posted on the Twitter feed. I had the red arrows. It's pretty clear to see where the movements are going to come from. When we had that big moonshot yesterday, okay, that was a monster short squeeze. I'd drawn this line way back, and this arrow was already there. And I added it right there because it is possible, it is always possible that it could have overshot and then hit the upper end of this trend line, of this uptrend line. Could have happened, but it stopped here exactly. And that is, in my opinion, I got to take credit for it. Fantastic tactical charting. Okay? And all I basically did was I drew a rising wedge. See? I joined the points here, and it automatically extrapolated here. And that's exactly what the markets went. I've said before to many of my ACS students that I'm not a charting genius. I simply know how to draw these lines to perfection. And you can't tamper with lines. I can't take this line and make it all curvy and stuff to meet my thoughts and needs, right? Nope. It's a straight line. And that's exactly what happened. And I said sell. SPX calls. I said selling 90%. That's basically verbiage for to sell out of things and leave a little bit in there just in case it goes higher. Didn't. You start to see that fall. You're out of that 10%. What I didn't do, and some members did, I'm very proud of them, is they saw these candle movements. They had their gut feeling and they shorted. And they made 100% on the downside on this rapid fire waterfall decline. That's one thing I didn't do. Because there are different ways to skin a cat. I didn't misread what was going on. I didn't expect the market to have a waterfall decline that fast and covered the whole range within 2 hours. It's okay. I take responsibility for it. Big deal. Didn't matter. There were huge profits taken on the upside. And this full range was covered, which allowed us all through the day today all through the day today. And let me zoom in now. There you go. So this is the range we're in. All through the day today, through this volatility cluster, to accumulate on selected alerts that's out there. I'm not saying buy the heck out of everything. I'm talking about short-term tactical trading. SPX calls, for example, the 2475s that alerted. At the time that I put my first alert in, which was all the way down here, it was around 260. It went down to as low as 245, ended the day close to 6 or 570. Pretty damn good. Did I buy the lows exactly? No. My cost basis was a little shy of 3. Still almost 90+% higher. Can't beat that. Okay. The 2480 calls, which were further out the money, were $1.15 at the low. At the time that I alerted, it was around $1.40. They slipped down to $1.15. Could have always added there again. Won't ever catch the bottom. Let's say $1.20. They went to $2.80 at the close. At the close, okay, $2.80, and moved all nicely along the way. And then you had that quick second dip, which is basically an inverse head and shoulder. That's your head. There's your left shoulder, your right shoulder. Or you could call it a double, almost a triple bottom. No, it's actually not a triple bottom because this bottom is lower. I call it an inverse head and shoulder right there. You can see that. There you go. Okay. And I knew this was going to happen. I knew it because I was looking at the internals, and the internals justified this move. And I show everything all through the day with comments, so you could basically self-teach yourself how to navigate these type of things. Because this is not the first time it's happened. It's happened it's the same routine because machines use the same programs when they know that the market's not completely falling out of it. Falling into the abyss. Now, things could be different if we got more comments out of North Korea, if we actually got a physical incident of North Korea doing something, and then our bombers going and pummeling them, or even taking down, let's say, our U.S. Air Force out there. We have a huge base in South Korea too. Basically taking down a North Korean plane, fighter plane. Well, that's a different story. Then this range would have broken. But what was the first thing that I put out there in the morning? The comments coming out of Rex Tillerson. And that, it wasn't an escalation. It was a de-escalation of things. The Secretary of State, Rex Tillerson, you can't take these guys like, that's a serious guy. And yeah, I hope you guys know who he was. He was the head of Exxon. He's a brilliant guy, okay? So it's not like Trump getting all fired up and saying, fire and fury. This is Rex Tillerson, the calm head, talking. All right? So that's the first thing that I put out there. So people know that we're not going into a firefight first thing in the morning over breakfast. So all these things matter. So saying all that, the range stuck, and all through the day, I showed the technical. I technically persuaded my traders to accumulate. And they got paid. Now, as a tactical trader, when it ran up and it hit this downtrend line almost, it backed off a little bit. So you could always take profits and say, okay, I'm done for the day. You get done for the day, absolutely. I took some profits there. And then it comes down, and then it just shoots up. And that started at 3 p.m. So whatever you guys were doing, whatever the case may be, this is an extremely strong, solid finish. Now, in very simple terms, every single time these flash crashes and these pullbacks have happened, like I said, the market has gone to the upper end of the range. This is the real upper end of the range, 2480. And now there is another range here, which is roughly 2490. This is the range the market generally trades in. There. That's the outlier. And there we are. So this is 2477, roughly 2483 on S&P 500. Good enough. You bought it at 24.60. You held your nose. You looked at my charts. You added a little bit more, or you just sat with the original buy at this level. You just bagged yourself 20 points. I'm sorry, from here to there, approximately 17 points on the S&P 500. It's already up 100+%. It'll be up 200% by the time it gets to this level, because this is the zone that the market's trading in. That's sort of the higher end of the range. This is sort of the median range. That's the word I'm looking for. This is the median range, 24.77 and 24.60. Look, I'm basically a tactical trader. I'm a very technical trader. I know a lot of crap about the markets. I understand global politics to a degree that most people can argue with me on things. Okay, and you have to respect my knowledge on that type of stuff. So I mix all of that in. I look at the sentiment indicators and everything going on. I know what you guys are feeling. I know how retail traders think. Okay? Because it took me a couple of years to completely change my mindset. So I become a robot. Now, I don't expect everyone to become like that. And in order to become a robot, you don't need endless sums of money. With a small amount of money, you can be a robot. All right? So bottom line is that I'm on this particular update, I'm just going to be very technical about things. And so just so you guys understand my charts, I just want to make it clear on that. So this is the level where we're going to hit a roadblock right there. And it's very clear to see right there. This is the range. That range is roughly, like I said, 24.60, 17 points. That's a very tight range. 17 times roughly 6, you're looking at 102 Dow points or so on the Dow Jones, which makes a big difference to stocks moving. No question about that. On a 60-point move on the Dow, certain stocks move like rapid fire, right? Got to know which ones they are, and that's the ones I keep on showing. The fast-moving, high-momentum beta stocks, the Nvidias, the Alibabas, the Apples. Netflix was only down $2.86 after being down a lot more last night because Disney decided not to carry Netflix shows, as if Netflix really cares. Okay, I don't think Disney shows are really a big component of Netflix. So Tesla, forget about it. 10, 15-point mover reversals. Amazon kind of stuck there. So anyway, so those are obviously the high beta momentum stocks you can generate a decent sum of money. All right, so that's the range. So when you look at this chart tomorrow, and I'll be updating it, this is your roadmap. This is the only thing, honestly speaking, that you need. These bear kill zones, which I put well before this happened. So the first level has been met. Will it get to the highest upper level here? It looked like you wanted to before this happened, but from my experience, generally speaking, and I'll show this to you on the Thinkorswim chart, the ferocity and the consistent buying from 9 a.m. as the markets open at 9:30 is something that opened my eye a little bit. Like, wow. It starts off with short covering. There was not one single on the 4-hour charts, because that divides the trading day into two pieces, right? There was not one single red candle. That shows there was some pretty heavy duty buying that went in. And those are not millions of dollars. Those are billions and billions of dollars going into the market in the form of short covering, which is the same thing as buying. Shorts have to buy to cover, and new buyers buying off tactical levels. We're nothing. We're just small fries, right? In the bigger scheme of things. So that's it. So very simple. I've added the MACD here. You saw the MACD cross happening here. In fact, this is going to stay on my charts. And that MACD cross was when this big volatility cluster was going on for the first 2 hours of the day. And volatility clusters happen because there are margin calls to be settled. There are panic sellers who want to get out. All kinds of stuff. So the market absorbs the selling. And as it absorbs the selling, it stays in that range. It did not break the 24.61, which is a big, broad red line here, because that's a different story. Then we're talking further down. It absorbed all the selling from this ferocious waterfall sudden volatility sell-off, which was, probably, I don't know, $250 billion that got sold fast. It's a lot of money. So obviously there were margin calls, institutional margin calls, retail margin calls, and that had to be taken care of. And that's what happens with volatility clusters generally within the first 2 hours of the morning. That's why you always see the market digesting within a support level, and then it's free to move. This one was 4 candles. You can see that. Red, green, red, green. So retail traders generally, a lot of you guys included, get all flustered because you're just looking at the prices. I'm looking at the charts first, then I'm looking at the prices. Repeat, I'm looking at the charts first, then I'm looking at the prices. And by the way, this is investing.com. It's free. All right, just pull up your thing and try to draw it as well as do. If you need help, I'll help you put it, set it up. It's not rocket science. So, and you can just by this, you can do it. And each of these, this move alone, you double your money on the S&P. And you can't beat any other business by looking at a chart. You made that kind of money. All right. So here's your uber euphoric zone. Here is what the markets broke down from. My gut tells me this whole, and of course there's going to be volatility. Remember, it doesn't go in a straight line. It goes in a zigzag pattern. That's volatility. So bottom line is once it hits here, it might just move sideways or even come down here. But one or the other, my gut tells me, and I don't know the time frame yet, could happen by this Friday, that it will get up to the upper end of this zone and complete this pattern. Simply because I'm a pattern recognition kind of guy, and this pattern is telling me that it will do this. So if it does that, that's a lot of money on the upside. But the only way, like I reminded a great member of ours, Andy, today, he said, let's get and hit that new high again. Normal retail trader type of talk. I said, what difference does it make if you're not positioned right? If you're not positioned right, this happens all the time with retail traders, then you're not making the money. So who cares if the market hits the upper end of the level? You didn't make it because you never bothered and you were too scared. And it takes few dollars. Few can get big. When you're looking at 300-400 type of gains that we're showing, you don't need to put $30,000 in a trade. You don't need to even put $3,000 in it. Put frigging 300. Take out 300% of that. Whatever you do. But this pattern, in my opinion, will get completed. So far, all the indicators are showing that it's in good internal health to do that. Now, things will obviously change. Now, we could also, because it is, after all, a completely news-driven market, we could also do this and create a very large macro dragon bullish. So you get a second chance to basically buy these lows because you missed it today for whatever reason, mostly because of SOA thing. It's called, sitting on what. So bottom line is, that's the purpose of me doing this session, this free market updates. I want you guys to be, pretty clear in understanding the stuff. So then you get a second chance, and that second chance you cannot miss, because if it vacillates here, creates another volatility cluster, all the internals may be moving sideways. Well, if it does this, then it's going to reset again like that. It resets again, for example, and I show so many different stuff which are very clear about, and I put comments in there too. You got to take full advantage of it, because then it's going to be a power move. Is it possible that this overshoots all the way up here? I don't think so. Okay? My gut tells me, based on my technical know-how, that the markets are going to hit a roadblock. Remember, this is a channel that the markets were traveling in. It's the way I look at it. It fell out. It killed, decimated the shorts by getting out of this highway. That's your highway, the blue dotted lines. And then it decimated the longs by getting out of the highway into the ditch. Okay? And now it wants to get back on the highway. So once it starts to get back in, that's your resistance level here. It's also lower channel resistance. So obviously, you're going to get some selling here. That selling could be like this, or get another news flash coming out, and the fat man Korea says, you know what, we're gonna drop some chicken eggs into South Korea, and whatever the case may be, maybe there's a little firefight right at the DMZ, the demilitarized zone, right there, you know, and some soldiers get hurt. Then obviously you're going to do this. So I'm prepared for all different scenarios that can happen. The range breaks, different story. Short at will, but you got to be quick. If this range breaks, it's going to be a fast movement. Now remember, each of these lines are downtrend lines, right? Which we took out. So this downtrend line will act as support on any pullback. So it could do this, or it could do this, or it could fall out of bed. That's real falling out of bed at the 2460 level. At that point, follow this line down, because these lines are really picture perfect, okay? You're going to fall to 2440, and that's a 20-point drop. That's another 120-point drop on the Dow Jones Industrial Average. What's going to happen after that? That's another day story, and of course, I'll be posting you guys real time on what goes on. So people getting in at this level here, in my opinion, are going to be making a fundamental mistake. But that's exactly what retail traders will do, because they'll be like, yes, this market really wants to go higher now, blah, 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 blah. Because at that point, there's going to be some pretty heavy duty selling, because that's really where the breakdown started, when this support couldn't hold. So but if it busts a move, is it possible that these type of waterfall declines that we got, and we have seen it before, replicated on the upside in the form of fat short squeezes? Absolutely. And then comes the big resistance right there again. That's it. Now, next chart, which shows it in a more dramatic fashion. So here's your E-minis. I watch it like a hawk, obviously, because I'm trying to help you guys, make a few bucks and not think that everything's just finished, whatever. This is more glaring. You can see that. Many of you use Thinkorswim. This is a 1 hour view. I have the channels drawn. You can compress it. You can see it. Okay. Let's decompress it so it's clearer. Here you have and it goes back, a bit. So actually, let me show you. Perfect. So this is it. Beautiful. Okay. You've seen this chart before. Now you're hearing it from me, the creator of these very precise, I will say, trading charts. Each lines are drawn. This is exactly what the markets go or fall from, right? Right there. So all you got to do, you don't need to calculate anything. You're like, okay, this is your range. This is your range, 2480, lower end of the range, where there was a massive monster reversal back not too long ago on the 27th. Like I kept on saying, this is pattern symmetry. And I'm sure you guys read it. I hopefully read it. 7/27, 2nd of August, and now. This is the face of the modern market that we trade. This is not, like I say, grandpa's market. And if you show this type of a volatility pattern to a trader from, let's say, 20, let's say he's been trading for 30 years and stuff, knows everything how to trade, all the gurus out there, they're all friggin' lying. They don't know how to trade these markets because they never draw the charts like this. They never do. They're all looking at moving averages, which I do too. But I'm not trading off moving averages. I'm trading off my specific structured levels, and they work, and they work really good. These levels are there for you guys to use as actual roadmaps, waypoints. Like a video game, okay? I used to love I was never a video gamer, but I used to love the flying games. Raptor 2, I forget. They were great. They're always waypoints, so you had to go, use at that time did the joysticks and all that stuff, right? So it was awesome. So as long as you knew how to follow the waypoints, like you do with, like this tactical charts are all about, you will go to get to your destination. and get those high points, i.e. high profits. So these are all laid out. So this one is pretty clear. Now, notice one thing here. This is this closest thing to this, but what I noticed and I showed out, and this is the real detail, the devil's always in the details. But the Germans like to say the details are the products. Okay? That's the German way of saying it. Ask a German automotive engineer, then they'll tell you that. Devil's not in the details. The details is the final product. That's why they make some of the finest, cars in the world. So do we, but their cars are better. All right. So the bottom line is that I said before that this was one of the largest movements of candles. This is a 1 hour chart. I'll show you the 4 hour chart before we finish this update, and you're going to see the difference. There's more noise here because it's a 1 hour chart. And I noticed the size of these reversal candles were significantly more powerful, validated by powerful green volume bars. This was the quick sell-off. That was the 3 o'clock one. No, 2:31. That's generally, by the way, just so you guys know, 1:30, 2:30, and 3:30 are when the margin clerks go chop, chop, chop. You don't come up with your margin call, they're going to sell you out. So you generally get those sell programs during that time. All right, that's from my old days on the street. So you got a big margin call, let's say, a big institutional margin call, like $500,000 or $1 million, whatever institutional account. They haven't wired the money in. Well, guess what? They're going to sell you out. So that sellout is shown in the form of these red candles here. But nothing really changed because the internals were clear. They were going higher. So nothing changed. And this level that I had put as a support right there, you can see that 24.6332 held. That's exactly where it bounced off. So now, again, there's going to be a fight at the gate of 24.77, 24.80, trying to enter back into this upwardly moving uptrend channel. And of course, there's going to be a fight here. And that's what I explained in the previous charts. So this, using Thinkorswim, and just go there, you just set the levels the way I'm setting it. It's not rocket science. You go here, drawing tools. I'm going to put one here. Instead of red, this should be bingo. That's 24.7456. So as a trader, right there is where it needs to break out of in order to hit the next level, which is 24.78. And each of these S&P points or E-mini points are worth money in your pocket. Do I think the whole pattern is going to be completed tomorrow? Absolutely not. But I could be dead wrong. Of course it could. There could be one. Believe me, I'll tell you at the end of this thing what I think is going to happen with the North Korean situation. All right? I'll tell you straight out. That's my outlier theory, and I know more about that part. What the situation out there is than most of you guys out here. So bottom line is that each of these levels are there for you guys to take advantage of and trade. And in the meantime, you had a crossover here, which was at midnight, actually. It was at midnight, and then this was the crossover at midnight, right there. The full stochastic crossover. See 0? That's midnight, crossing over into Wednesday. And all through the day, it was going higher. That itself told you don't need to be a rocket scientist, and I've said this hundreds of times, but I'll keep on repeating it till it finally gets to some of you guys. As long as you see the full stochastics, 1 hour and 4 hour, mind you, climbing higher, you gotta stay long the trade. What does stay long the trade mean? You got dollar cost average, you stick with it. Dollar cost average, you stick with it. Whenever I think that there's a time to dollar cost average, I will go ahead and alert it. I'm not saying people to dollar cost average every 5 minutes. That's stupidity. When I see this move up, you can take a nice profit, or as it's moving down, I said buy because I saw the reversal candle coming through. That was, to me, a defined, like I said, change this color. Like I said, There you go. That's where we landed up. One very important thing, and I know I've said it before, but I'm going to keep on repeating it over and over again. A true tactical, technical trader, it's a discipline, it's an art you have to perfect through a lot of hard work. Most people are not technical traders. They're emotional traders, and there's nothing wrong with it. But if you just mix in a little bit of what I do, it'll make you a much better person when it comes to this side of the business. A pure tactical trader has to act so robotic. I don't think many people have it in them to do it because most people are emotional, just emotional. They're not logical. You know, there were some people in our group who are so tactical. I am super impressed with them. Not because they're great guys or whatever. They're just brains just work differently. And there's some of them who are very smart guys who just will not. Doesn't matter what it is. Look at my charts or bother with them. They like me. They know my alerts work, and they'll just buy it random, whatever they do. But they don't make the big money, by the way. Okay? So I'm putting through a structured, very mathematical way through visually mathematical, where you don't have to sit there and do algorithms and calculus, right? And statistics to figure out the answer. It's shown in a very visual term how to play your emotional aspect of your brain so they're not number one. Your primary trading vehicle should be the tactical charts. The emotions should be secondary. I look at stock tweets all the time. I don't see one single person. The old guys have the same old story. There we go with the dip, BTFD, blah, 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 blah. Tell me if I'm wrong. That's all they keep on doing. The bulls are just sticking to being super bullish. The bears are, there's no real concrete. There's no substance. And I'm sure they're smart guys. So what I'm doing is taking all that BS talk out of there we go again, wow, market can never go down and all. I mean, I read so many types of insanely stupid comments, and retail traders do that all the time. And some of them do that in my room too, with you in the chat room. That's okay. Point is that what I do is take this and put it in a picture like this where you can make some real money and don't lose your head when you make good money, and don't lose your head when you're down on something either, because you can make that up very easily. But that ease won't come because you're sitting around doing nothing. That ease will only come where you take advantage of all these fantastic navigational tools that I'm giving you. So let's take a look on that 4-hour thing that I told you. And this really blows my mind because I even told you guys. I mean, the stuff that I put out there, to be honest with you, it's literally like I'm giving money away, and many of you are just not bothered taking it, which is fine. It's up to you. What do you want to do? So the 4-hour is very powerful because it cuts out all the noise from the 15-minute, the 5-minute charts. This is really for people who are looking to make that 110, 120% during the day and following through with it depending on which way the charts are going. And there's a lot of positives on this one. From a tactical bottom, I've said it before, the most aggressive buying normally should happen in this zone. Okay? Or if we get another minor dip. Because this is where the perfect moments are. I always wanted to say this. There's a quote that I put out there, there are no perfect moments, just take the moment and make it perfect. Well, these are the perfect moments to buy, where things are on sale, where selected stocks are on sale. SPX is on sale. They're cheap. They're bargains. You can make a fat load of money by buying these levels. Therein lies the sort of the dichotomy of the whole thing. Is where there's another word I'm looking for. Is when the retail trader doesn't. And it's so sad because it happens all the time. So these are your perfect moments. And when I'm showing charts and candles that are this powerful, you don't need to be a rocket scientist to figure out that when you're seeing candles of this side on the 4-hour charts, all day, nothing but buying. You think this is the dumb money? That's the smart money. All day, big, fat volume candles. For some of you who might be very new, don't know how to read one, well, read it now. Here, this one, look on the right, that's a 754 million, 754,000 contracts. That's a lot. Okay? And let's say you can't figure it out. Well, why don't you just look at it visually? Look at this all day long. That's saying something. Okay? This was back on the 27th, the first one, right? The first flash crash and the big hammer reversal. Look at that. It's a beauty. That came on the second half of the day. The first half of the day was red. Today, it was all green. And generally, back to back, I don't see both. This was 750, there's almost 800,000 contracts. This was almost 500 to 600,000 contracts. That's a lot, guys. But let's say you don't know what those numbers mean and stuff. Doesn't matter. Just look at it visually. That's what I showed during the day. I even wrote it down. So big short covering, new buyers, and then we got these candle movements. Beautiful. So the probability of this pattern getting completed, even though I'm always skeptical about things happening too fast, too quick, but that's what the markets do, is pretty high. It's pretty high, given what we are seeing underneath the surface, amount of money that went in between short covering and buying. Here's the most important thing, which I even pointed out with big yellow arrows. Feel free to see them on my, on my Twitter feed. Show this one. Okay. Towards the end of the day. Can't get any simpler. Green buy volume bars, institutional short covering, new buyers, bullish, 4-hour tactical roadmap. So what was this? This was the volume arrow. And then you had, this gets there, okay? And then this. Now what is this? This is the crossover. There you go. This is the crossover. You get this crossover, that in the old days we called a confirmation. Nowadays I don't call it a confirmation per se, because I don't like to confirm things anymore. Let the markets do it. But this is a confirmation. This, and look what happened. The crossover hadn't happened yet on the previous one, right? Look, it was just starting to happen. How do you get this stupid shaded part out of here? There. And look it now. It did cross over. Gotta give it. That's fantastic. Now, can this double dip? Sure it can. But generally, when you have a crossover, that means markets are ready to move higher till it gets overbought again, over 80. The 4-hour chart is critical. So when I'm showing the 4-hour charts and I'm putting those type of comments, you gotta do something. Look, I wake up every morning. I'm skeptical about the market as far as you can throw it. I never walk into a trading day feeling like, yes, even on the best days when everything's up and I just walked in, we're positioned right. And we've done a lot of those, okay? And it's just within the first 20 minutes, you're basically loaded. And you're like, whatever, I'll just play with some house money. Okay? And many of you have done that too. I still never rest on my laurels. That's just me. So, right there, because I know exactly when most of the retail crowd gets excited, that means on a technical basis, that stock is overbought. And guess what happens? Bang, down. Back recycle again. I want to be the early buyer. I'm always the early buyer. That's the reason I kept on telling people this was 5 in the morning, so this is the start of the trading day. Okay, this green one. That keep buying, keep buying. This is going on. This is going on. This is curling up. You didn't need much, you didn't really need rocket science to figure this out, especially when I write it in very simple terms. So compressing it, upper end of the range 2490 is doable. My opinion, could happen very quickly within the next 24 to 48 hours. Or, like I said, as the indicators go, 5-day. Remember the yellow line, okay? That's the 5 SMA. Has now turned higher. And when the 5 SMA turns higher, that acts as short-term support underneath the rising candles. And you can see the candles are kind of ticking. Futures are down by 75 cents. Yeah, big deal. And this also, on a pattern standpoint, I showed is a cup and a handle. If the handle breaks, the 5 goes down like this, and we are back towards 2464, which in my opinion is very solid support because it has acted as support multiple times. That means there's a solid set of mechanical algo high frequency trading buyers at that level. That's how you read these charts. And there's your downtrend line. Can it slip to the downtrend line and bounce from there? Sure it can. Sure it can. Okay, but this is positive. That gets a tick mark. This is very positive. This is, let me see. This is definitely positive. Whenever I'm looking at positive things, I'm also looking for the negative. This was right after the market closed, 5 p.m. So there was a little sell here. What I could kind of say is not fully positive yet is if you look at these lines here, which is the 34-day and the 50-day, they need to curl up like the 5. Once that happens, you are going to get a retest of this. But once these lines curve up. But generally speaking, because the market's been trading in a very tight band, guess what's happened? You can see that obviously. Is that the moving averages, which is the 34 and the 50, I give a lot of weighting to those, have generally kind of moving sideways right there, just like that. So through that, there's been big time moves up and down off the highway, which is the 34-day moving average at this point. So once the 34-day moving average starts, because all through this, we have made pretty decent money on these big fat reversal candles and stuff like that. Even here, this was a big one. The 34-day moving average and the 50 kind of never did anything. They're still moving sideways. So either they're going to come like this because there's still a lot of selling pressure, or if they turn up, that means the market is going to go to this level. Only when I see the 34 and the 50 turning up. But I'm not going to be waiting around for that. I'll trade the markets based on these levels that I see. So people who are waiting for these big sort of climactic events like, oh, the moving averages finally turned up and stuff, never really make the money because they're always waiting around for that huge perfect moment when everything is confirmed and it's good to go. One thing I've learned in all these years from Wall Street and then being completely on my own, markets never give you a real signal. I don't care what those guys out there tell you. Okay? They give you signals, very precise signals based on these type of tactical indicators and everything that I use. But they never give you a green light and say, buy me, buy me, buy me. Stocks do. Markets don't. Okay? Stocks do, but markets don't in general. So this is not some huge like, okay. And by the time they do, we can only study it in the background, like on the weekly chart or something. So can this happen? It sure can happen. And if it does turn, I think this will happen. Can the 34 and the 50 start moving down? Yes. And what does that mean? That means that we're going to lose this support. But generally, the 150 moving average, which is that magenta line here on my charts, is a very powerful support. Because breaking that means there's some real foundational break on the market. Let's look at the daily. Looking at the daily, There used to be a thing here where I could hide these drawings, but looks like they took it away. I got to talk to Thinkorswim because I don't want to clean out all these charts so that I got to redraw them again because they're pretty perfect the way I drew them. So anyway, looking at it, just look at it. You got this. This is your 20-day moving average. The market bounced exactly off that. This was the ninth. This was the ninth. This was today. This was that big hammer reversal. Wow, you can see that now on the daily. Today was the ninth. Today was the ninth. Wow, it's the first time I'm seeing it because I didn't look at the daily during the day. Look at that. That's a hammer, guys. That's a real hammer reversal. That's a nice hammer reversal. Still like a red mallet, right? That's a hammer reversal. This is a hammer reversal, but still kind of red. This, gentlemen, is a real hammer reversal on the daily. What can I say? And look at the volume on the short covering and stuff. Pretty big. Above average. Very big. 1.56 million contracts bought. Think this market's going to crash and we're in a bear market? I doubt it. This, ladies and gentlemen, as I put it highlights, this is big. Can it vacillate back and forth? As long as they don't lose this hammer, and this hammer doesn't go like this, we are okay. I hope I made that very clear. Anyway, let's see what's happening on the stochastics. There is the negative divergence at play on the daily. The negative divergence on the daily actually started when the markets were approximately around 24.75. You can see that it's still building. It's still building. That's telling me that there is still some selling pressure left in the market. However, given yesterday's thump, look how fast this one turned. This is your base level where off the RSI 40 or on the full stochastics, it's roughly around 40, where the market's generally base. So a little bit more selling maybe. I don't know. But if it gets down here and turns, you got to buy the swings hands down. That means the market's going past 2,500, possibly towards 2,600. And longer term charts will show that. That will only happen once we see the internals based on the full stochastics, and I'm just looking at one indicator here, which start to move higher. We haven't seen that yet. So there is negative divergence on the daily. The actual structure looks great. And one of the final things I'll say, markets have a very strange way of changing directions. If it's fallen really hard, that's a 15-minute chart, by the way. You can trade off my charts on the 15-minute charts too. Okay, lots of noise, lots of MOHTR. You know what that means, right? Monkey on a hot tin roof, price watching retail traders jumping up and down like nuts. This was the last two candles, buy candles at 345 and 4. That is a cup and handle, by the way. Okay, that's a cup and handle. And in between, you got a triple bottom. So there's a lot of different patterns at play here. They're definitely positive pattern, no question about it. Okay. What was I going to say? Oh, so when markets turn directions, and I've been caught on short trades where the market suddenly just turned around. It just went against me. I'm like, holy cow, it just turned from midair. I don't have time to react. I'm down 40% in 3 minutes on the SPX puts. Okay. So bottom line is that in a bull market, those type of directional moves are known as breadth thrusts. I can never pronounce that word. Okay. It's like a lisp. Breadth thrust. It simply means with a very powerful force, you break out of a certain range. Like I always like to use the shuttle analogy with the booster rockets. So the rockets, when we were flying into orbit, the booster rockets thrust. So the thrusters, okay? And that happens in the form of a large green candle that just appears from nowhere and just takes you to that. There you go. So all that stuff that I'm showing you, in order for that daily internals to curl back, all you need is a 200-point up day, that type of stuff. And believe me, it can happen. Okay? If oil wakes up a little bit more, a couple of those oil monsters, Chevron, Exxon, ConocoPhillips, EOG, all these beasts turn around and have a monster day, you'll get a 200-300-point day easy. So bottom line is the thrusters are there in the market. One tweet out of good old Donald that the tax plan is almost complete. You watch what happens. So the thing is that that's what generally happens in bull markets. The bull market is far from dead. It will have severe corrections. Faster the correction, better off for us. Keep using my charts, obviously, at your own will. But the more you understand it, and the more the way I do it, and I try to make it as simple as possible. Where's the 4-hour one? There you go. You'll be in great shape, because these structures are not what usual traders are used to trading. They don't even understand it. I showed, I post just a few of my charts on stock twits time to time. So I got a comment the other day, goes, nice lines, man. Maybe you should get some more crayons. So I wrote something funny back, because I don't like slapping weak people. You know what I'm saying? So that is the type of redundancy, stupidity, idiotic comments that you hear, because they just don't get it. That markets are not random. They're structured. This is not a random walk through Wall Street that Malkiel had wrote years and years ago. This is a algo robotic walk through Wall Street. So if the more you understand my charts, you yourself will be amazed, and you should be, because I'm already showing it to you, because nobody showed me charts like this when I was learning trading, like so specific about each level. They didn't. So then you'll be able to manage your trades better. That doesn't mean we're going to take hits on this and this stock, whatever, but I'm just saying in general, that's just the way it goes. That's your Tesla, picture perfect. I trade off this chart every single day or swing. Okay? And so can you. Reading candles takes a little bit of work, but you can trade each of these candles. That was the big $9 move. Alibaba, beautiful. I just left that simple chart out there. And then for shorter term, I use the Thinkorswim ones, and I've shown it to you guys what those levels and stuff are. This is your swing chart. The stock is, unless they do something really terrible and they break below 148, the stock is destined to go to at least to the mid channel. That's 167. That's a lot of money. All right, everything's fine here, and this is a daily, just cutting out a lot of the noise. Now, if it breaks below this, right, that's the breakout zone right there, which is 147, then we might be looking at some lower prices, obviously. But as far as I can see here, if it, and they should have really strong numbers, because they're expanding like nobody's business. So this breaks out, it's going straight here, and that's close to 170, 165, 168. That's a lot of money again. That's $11 from here, guys. And the options are cheap. And I don't care about Alibaba. You know what I'm saying? And so the options are cheap. They're like $1, less than $1, $2, and they move. NVIDIA, what can I say? This is one of the best charts I've drawn. Look at this. That's a bull flag breaking out. One of the biggest winners today. Biggest winners. Options turned around. They're not as frisky as the SPX calls and stuff. They were good for 50, 60, 70%. Stock turned around $6. And depending on which ones you bought, if you bought way out of the money, they'll probably be higher percentage-wise. But that was powerful. Consolidation channels. I hope you guys understand that. These are consolidation channels where profit-taking happens. As long as it holds the consolidation channel, we're good to go. This is fine. So that's another great looking one. This one, So a lot of basically went up $1. You don't want to like put your whole net worth into it. Then they went down to 20 cents. But this is a long-term channel on GW Pharmaceutical. So this channel should hold and it should bounce from here like that. And this is a monthly. Wow, this is a monthly. So 100 to 120, it's no big deal. It still stays within the lower channel. And if it does break out, it's going higher because this is a real company. Real company. What's this one? That's Alibaba on the 1 hour. It's solid. Coming off the bottom. So that's it, guys. I'll answer one or two quick questions and then we'll wrap up because I think I've covered quite a few of these things. And any quick questions?
Frank, on your Thinkorswim chart, I was curious, those lines that had the horizontal lines that had 3 different colors that looked like fib retracement, but I wasn't sure. It didn't appear to me that that was necessarily what those were. I was just curious.
No, they're not fib retracements. They're actual lines that I drew, and I just added the value to it. That's all. You can go edit properties. They're really helpful. You can basically just add when you draw the line. You just you look for the function which says I don't know why it's not here. Oh, show price right there. You know what I'm saying? So normally it says do not show. Right. Nope, these are not fib retracements. They're actual levels. Now, good question you asked. So a lot of people, please listen. The way I draw these lines, I look for, and I mentioned this before, for points of supply and points of demand. Points of supply are where there are sellers, okay? Multiple sellers. And it's not perfect, but it works very well. And points of demand are where there are buyers. There was big reversal here, so that's a demand point. So supply point is the sell zone generally, and the demand point is where the buy zones are. So my lines are drawn to reflect the levels where the markets had big support, and I could have drawn another one here, and that would have shown like where it can go. So no, these are straight lines, and then the channels I basically just draw based on multiple points of contact, and you can clearly see that it puts a whole framework of what the markets are doing. Okay. So those are just standard lines, not Fibonacci retracements. I only use Fibonacci retracements on distressed moves, on big distressed moves, as you know, and those tend to be big crashes. And we play like Alta Beauty, use fib retracements on that because that clearly tells me where it can bounce to before it starts to falter again, or whether it wants to go higher. This, ladies and gentlemen, is a daily chart of weekly chart of the S&P 500. Just wanted to highlight this to you guys. This is a weekly macro bull flag. This one, this big one. It's also a rising wedge, right? This one. These lines are simply channels. And guess what's going on? This is going. Is this extended to the right yet? You can click extend to the right. Good. So guess what happened? All we did was got to the upper end of the rising wedge. We hit the upper end, and then and this is going all the way back to February of this year, February of 2016. Sorry, yeah. This was November. This was elections. So this was elections, right? This was February of 2016, the 1800 level. A lot of bears talk about the 1800 level getting revisited. Yeah, it will happen, but it's not going to happen that fast, okay? There's way too much money, institutional money that have gone into the market, and they're not going to flee all of a sudden. And that's one of the biggest things that retail traders don't understand. Maybe it's such a simple concept because I come from the money management side of the business, guys, okay? Fund managers just don't flee and say, okay, we're just going to go and park our money in money markets and earn 0.0001%. And the biggest guys in the world who own stocks are mutual funds, not hedge funds. Hedge funds don't even really own stocks. They actually just borrow stocks. They're mostly traders. They're glorified day traders. Yes, some hedge funds, activist ones own chunks of companies and stuff like that. So if you think about an asset class, like they say, money talks and you know what walks, okay? So if they're not going to completely flee the market, why should the markets drop? If there's a big credit crisis, they'll park their money and pull it out of the market, leave it in money markets or bonds. That's a different story. So that's the bigger picture. So when you look at the weekly chart here on the market, there's nothing. There is this is a doji. So you can say, okay, there was a doji here, and then the markets went up a little bit and corrected. I think that's exactly what's going to happen. See this doji, this one? Let me just clear this out. Let me zoom in. That this is real sort of predictive forecasting. It works. I've done it a lot of times, and I have a pretty good track record of doing it. So let me just tell you guys right here on the weekly what's going to happen. The upper end of the weekly channel is around 25.15. Dan, you and me talked about this before because you had some calculations on your side which matched with my numbers. So way upper end is around 25.73, right? That's going into the upper channel. Forget that for a minute. Let's look here. Upper end of this channel is 25.14. We could hit that in the month of August before the September correction. September will be a correction. There's no question about it. Real, going into, who knows? And it's not going to be weeks and weeks because things happen so fast. But there will be a big one in September. Big meaning 400, 500, 600 point type of move. Okay. Now, you got this 5-week moving average moving up nicely. You got the 20-week moving average moving up nicely. You got the 34-week moving average still trending. You got the 50-week moving average, which was kind of flattish, now actually starting to edge up a little bit. Very interesting. Okay. The whole key is that this is candlestick dynamics. Feel free to listen to that candlestick video that it's on my YouTube channel. It's worth listening to. So if you match this one to, let's say, this one here, I mean, forget matching it. This is a doji. All right. I saw one more. And so this doji basically says, okay, minor indecision. What happens after that is either it's going to move up a little bit or it's going to fall to the lower end, which is 24.43, 24.44 on the S&P, which is 30 points lower, which means another 140 points lower. That means, 240 point correction. So this minor correction, minor move here to the lower channel without doing any technical damage whatsoever is 240 points on the Dow. A lot of guys within our group, hopefully not a lot of them, because I think a lot of traders here are starting to understand and practice technical analysis. It's almost like a religion, okay, and a good one too. Technical, tactical trading is a 240 point drop is going to send you. You just wait till you see the headlines. They'll be like, whoa, forget it. It'll be like Armageddon. It's like the Russians are invading us, that type of stuff going on. That's it. The Koreans are bombing us, the Russians are invading us, and that's it. That's what the media is going to make it sound like. And all it's going to do is basically bring us down to the lower channel before it attempts to bounce again. So all these things I monitor. I don't monitor the weekly charts, obviously, during the day. But when we do these sessions and stuff, when I'm on my own, I look at them. Everything's there okay so far. Okay? So even a minor pullback, forget to the lower channel. Even a minor pullback to the lower on the lower arm of the rising wedge is 24.60. That's 14 points lower. Well, that's exactly where we bounce from, right? So even if we pull back here, that's 14. That's roughly about 14 points. That comes to about 80. Yeah, 84 to 90 points on the Dow Jones. So when you look at the weekly chart, you can see when most of the noise is cut out, nothing really happened. When things break the 20, when things break the lower channel, that's when I want to go nicely short. I mean, nicely short. That means things are not kosher out there, all right? Things are not that good. And there's a big fat gap here to fill at 23.70, and I think it will get filled in September. So 23.70 to here is 670 points. That's my last word. All right. It's going to come. It's not something that's going to be like evident, but if I see things of that, exactly what I told you, these things happen, then I know that's going to happen. Yeah, go ahead, Don.
You said when what breaks, that's when you would get aggressive or more aggressive with shorting. What
sure. If you look at this, let me take the pointer. If you see the lower channel here, which is 24.50, that's your first danger sign marker. right? 2450. This highlighted is the 20-week moving average. That's 2415, right? When these two break, you can rest assured that the chances of a nice correction down towards this level here to retest the 50-week moving average increases, the likelihood and the probability, because it is momentum, right? Momentum to the upside, momentum to the downside. Momentum carries a lot of weight. So if we break these two major lines, which is the 2450 being my lower channel line, right? You can see that. That's a very powerful uptrending line. And 2450 and then 2414, then you can pretty much, of course, look, if we break 2450, I'm shorting all the way down to 2415. I'm doing it. I'm doing a swing trade on that because this channel is so powerful that if it breaks, there's going to be, it's like a water breaking through the hull of a ship, and it's going to gush in. You got it, I'm saying? So there's going to be more selling, and then 2415 will be engaged. If we bounce from here, we'll see. If it doesn't bounce, then you got the 34. 34 is a very powerful line. Markets have bounced off 34 many times. Markets very seldom come close to the 50-week. Remember, this is not a day, Don. This is a week, right? This is beyond the 50. So the last time we came close to the 50-week moving average was during the election. In fact, we touched it after hours. If you remember, Dow futures were down 800 points, right? So we did touch it and go below the 50-week moving average the night of the elections. Okay? And but generally speaking, you can clearly see that those type of things don't happen too often. And it happened here too. When was that? Oh, that was Brexit. We kissed it. So there has to be a real credit crisis type of situation overseas or in the U.S. Let's say the budget, the what is it? They're going to fight in September over the budget bill, right? So what if the budget doesn't get passed? Oh, the spending bill. Sorry. And there's a debt, the debt ceiling doesn't get increased. Those type of things can bring you down here pretty fast.
And the purple line, that's the 150.
Oh, this purple line?
Yeah.
Oh boy, yeah, that's 150 moving average. That's gonna feel like that. That's like when you look that for that to happen, you need a. They're gonna start talking about. Well, that basically will push the U.S. economy into a recession.
Because that's actually what on the ES, that's where it would have hit the night of the election. It hit 2038. So basically,
Yes, exactly. You're right, sir. Thank you for reminding me. That's excellent stats. You're absolutely correct. Thank you, Don. So you're absolutely correct. So those are, if this is such a powerful line, the 50-week moving average, that it will hold. It's like, that's where, I don't care whether you're hardcore Tea Party or Republican or left-wing Democrat or moderate Democrat, that's when they say, that's it. The money's going into the like spending starts. You know what I'm saying? That's like all hell break. That's like QE3. You get it? So so that type of scenario. But yeah, you're right. You're right. But that's look. Those type of things happen, but it happens over a much longer period of time. So going into next year, for example, I could see that happening. You know what I'm saying? If the U.S. economy stalls, they can't get any of these bills passed, really passed, honestly speaking. I think they will. Then believe me, you're going to get that. But that's not something that's something that happens over a much longer period of time. But given where we are in this day and age of algorithmic high frequency trading, my good old Alco HFT analogy, okay? Not analogy, it's the real facts on the ground. Those type of things will happen quicker. What would normally take a year can happen in 3 months or 2 months. So that's
or an election night, 12 hours.
In election night, 12 hours. But if you look at it, we were already down here, though. You follow what I'm saying? We were already down here, so we're not all the way, up there before it fell. But that was something. Yeah, exactly. I mean, that's obviously,
And
very
Frank,
dramatic.
I want to hog all the questions. Just one on your preference. You have a 34-day and a 20-day, and I'm just curious, knowing that 34 and 21 are both Fibonacci numbers. Like, why do you choose the 20 and 34 versus 21?
I used to use the 920. I used to use the 9, 13, 20 34 and 50 I've always used, okay? And it's always worked for me over the years, so I use it more and more. The 20 was, again, my friend and our member, Jasco, he said, hey, listen, I trade off the 20 quite a bit and stuff. I said, let me add it, you know? And so I added it. So the 20 is used. You see, remember one thing. Sometimes it's good to use these averages, which a lot of the traders are looking at, because that's where they'll either freak out or get excited. So it's good to know, like they say, it's good to know what the others are doing. So the 20 works well. The 20 works well for me. The 34 and the 50 to me are constants. The 150 is basically primarily used by large hedge funds and stuff. That's it. That's a slightly different one, but the 20 is used quite commonly across the board. So I just, and the 34 and the 50, I can't remember why I started using it years ago, but works great for me. Not a problem. I don't really use the 100 that much. And the 200 day, I should add it on the weekly charts. But I find the 150 to be much more of a strategic moving average than the 200. You know what I'm saying? Even though the 200 is talked about more. So that's where we are. Fair enough?
Thank. Yep.
Cool, man. Great question. All right, guys. See you tomorrow. And I'm going to put this up tonight, and we'll take it from there. Have a great evening. God bless you all.